So, you own a few stocks. You see the numbers in your brokerage account go up and down each day. But that's just numbers on a screen. How do you actually translate that into real, spendable money? How does owning a tiny piece of a company actually end up putting cash in your pocket? It seems like a magical process, but it's actually built onto very straightforward, time-tested mechanisms. Once you understand these two engines of wealth, the entire stock market will make so much more sense. You'll stop looking at your portfolio as a random number generator and start seeing it as a collection of assets that work for you in specific, predictable ways. Today, we're pulling back the curtain. We're going to demystify exactly how you profit from stocks, breaking down the two primary ways your money can grow, and more importantly, how you can harness both for long-term wealth. The first way to make money, and the one most people are familiar with, is through capital appreciation, which leads to a capital gain. This concept is beautifully simple. It's the buy low, sell high principle you've always heard about. You make a profit when the price of the stock you own increases in value and you decide to sell it. Let's make this concrete. Imagine you do your research and you believe company XYZ is a great business with a bright future. You decide to buy 10 shares at a price of $50 per share. Your total investment is $500. Now, fast forward a year. Your research pays off. The company releases a fantastic new product, its sales are soaring, and more investors want to own a piece of it. This increased demand drives the stock price up. The share price is now $70. Your 10 shares, which you bought for $500, are now worth $700. If you were to sell those 10 shares at this new price of $70, you would lock in a profit of $200. That $200 is your capital gain. It's the difference between your selling price and your purchase price. The key thing to understand here is that this gain is only a paper gain until you actually sell the stock. The value of your investment fluctuates with the market, but the money isn't real until you convert those shares back into cash. This is why long-term investors often say they don't worry about daily price swings. They're not planning to sell for years, so they're focused on the business's long-term growth potential, not its day-to-day stock price volatility. The goal is to find companies that you believe will be significantly more valuable many years from now. The second powerful way to make money from stocks is often overlooked by beginners, but it's the secret weapon of many long-term wealth builders. This is through dividend payments. A dividend is a portion of a company's profits that is distributed directly to its shareholders. Think of it like this: you're a part owner of the business, so when the business makes a profit, you get a share of those earnings. Not all companies pay dividends. Typically, established, profitable companies with predictable cash flows pay dividends. Think of giants like Coca-Cola, Johnson & Johnson, or Procter & Gamble. Younger, fast-growing companies like many in the tech sector often reinvest all their profits back into the business to fuel further expansion, so they don't pay dividends. When a company pays a dividend, it is usually a fixed amount per share, and it's paid out on a regular schedule, most commonly every quarter. Let's go back to our example with company XYZ. Let's say that in addition to its stock price going up, it also pays a quarterly dividend of 50 cents per share. You own 10 shares, so every 3 months, you would receive a payment of $5 directly into your brokerage account. That's $20 per year in dividend income, just for owning the stock. Now, $20 might not seem like much, but this is where the magic of scale and compounding comes in. If you own $50,000 worth of dividend-paying stocks with an average yield of 3%, that's $1,500 a year in passive income being paid to you, just for being an owner. And many companies have a history of increasing their dividends year after year, which means your income stream grows over time without you having to invest another dollar. Now, the most powerful strategy emerges when you combine these two forces. This is what creates truly life-changing wealth. It's not just about capital gains or dividends. It's about capital gains and dividends. This combined performance is what investors call total return. Let's paint a picture. You buy shares in a fantastic, stable company that consistently grows its profits and also pays a reliable dividend. Over time, two wonderful things happen simultaneously. First, because the company is growing and becoming more valuable, its stock price appreciates, giving you that capital gain. Second, every quarter, you receive a dividend payment. But here is the pro tip, the insider secret that accelerates everything. You take those dividend payments and you automatically reinvest them to buy more shares of the stock. This strategy is called a dividend reinvestment plan, or DRIP. When you DRIP, you're using the company's own profits to buy yourself more ownership in the company. And because you own more shares, you receive even larger dividend payments the next time around, which buys you even more shares. This creates a powerful, self-fueling feedback loop of compounding. Over decades, this cycle of receiving dividends, buying more shares, and watching the entire larger stake appreciate in value can turn a modest initial investment into a massive portfolio. This is how people who never earn huge salaries can still retire millionaires. They let the twin engines of appreciation and dividends work together over a long period. It's also crucial to understand the mindset and the common mistakes that prevent people from making money. The biggest enemy is often ourselves, our emotions. Many beginners get caught in the trap of trying to time the market. They buy when a stock is soaring because of hype and fear of missing out, and they panic sell when the price drops temporarily. This buy high, sell low behavior is the exact opposite of what you want to do and is a guaranteed way to lose money. Another common mistake is confusing a company's stock price with the company's actual health. A stock price can be volatile and irrational in the short term. A company's long-term value, however, is determined by its earnings and its future prospects. Successful investors focus on the business itself, not the ticker tape. They understand that the money isn't made in the frantic buying and selling, but in the patient waiting. You make your money when you buy the right asset, and you realize that money through the passage of time as the business grows and shares its profits. Before we conclude, it is my absolute responsibility to provide a clear and serious disclaimer. While the stock market has historically been an excellent vehicle for building wealth, it is not a guaranteed way to make money. Investing always involves risk, including the very real potential of losing your principal investment. Stock prices can and do go down, sometimes significantly and for prolonged periods. A company can also cut or eliminate its dividend at any time. Past performance is never a guarantee of future results. This content is for educational purposes only and is not financial advice. You must carefully consider your own financial situation and risk tolerance and consult with a qualified financial advisor before making any investment decisions. Never invest money you cannot afford to lose. So, to bring it all together, you make money from stocks in two fundamental ways. First, through capital appreciation, buying a share of a business and selling it later for a higher price as the business grows in value. Second, through dividend payments, receiving your direct share of the company's profits on a regular basis. The most powerful strategy of all is to combine these forces by reinvesting your dividends, harnessing the incredible power of compounding over many years. The key to unlocking this wealth is not complex trading algorithms, but simple patience and discipline. Find high-quality businesses, invest in them for the long term, reinvest your dividends, and ignore the short-term noise. Do that, and you will have positioned yourself to not just participate in the market, but to genuinely profit from it for years to come. Now, I'm curious, which of these two methods of making money resonates more with your personal investing style? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.